Hi everybody. I wanted to continue working on our stockholder equity questions today. And the question I wanted to go over today was treasury stock transactions. Now, with treasury stock transactions, what we look to do is go over how a company goes about buying stock back and what kind of journal entries occur when a company buys its own stock back and then sells it. And then also, how do we record the gain or loss on these transactions in terms of, how much do you actually make or lose and what account does that go into? So I found the perfect problem that works with this, and now I can show you exactly how to do this. So let's read this question here. Pembroke Corporation started business in 2007 by issuing 200,000 shares of $20 par common stock for 36 bucks each. In 2012, 30,000 of these shares were purchased for 52 per share by Pembroke and held as treasury stock. On June 15, 2013, these 30 shares were exchanged for a piece of property that had an assessed value of 810,000. Pembroke's stock activity traded and had a market price of $60 on June 15th, and the cost method is used to account for treasury stock. The amount of paid-in capital from treasury stock transactions resulting from the above events should be. So the question is asking how much gain or loss are we recording, and that gain loss goes into this account that is called paid-in capital from treasury stock transactions, right? So how do we know what goes into this account? I would say first what we do is we want to record what happened. So it said here they purchased 30,000 of these shares for 52 bucks. So what we do is 30 times 52, just to see how much money that is, right? So at first we start by saying treasury stock, which is, we debit this account because we purchased it for 1.56 million, right? This is just how much the factor is, 30 times 52, right? And we just credit cash, right? Now the next journal entry that we get into is it says on June 15th, it's later on, right? 30,000 shares, same 30,000 were exchanged for a piece of property, and at the time the price of the stock was 60, right? So what happens now? You record property as a debit now. Property as a debit. And the property is worth 60 times the 30,000 because that's what the stock is worth. So you go 60 times 30,000. So the property is worth 1.8 million dollars, right? And now this was bought with essentially treasury stock. So what you're going to do is what you're going to credit is the treasury stock because that was debit before. Now you're going to credit treasury stock for how much? Well, all we had in there is 1.56 million before. So now you're just going to zero that out, right? So what's the remaining is the question, and the remaining is what is considered paid in capital for treasury stock transaction, which is going to be here a credit because you essentially had a gain on this treasury stock by what? The difference between 1.8 and 1.56. So you go 1.8 less 1.56, and this is 240,000. And this would be a credit to paid in capital from treasury stock transactions. So the answer is D, 240,000.